I just want to give you an introduction to VH, Global Sustainable Energy Opportunities PLC, fund listed on the main board of London Stock Exchange. It's an investment trust company. We listed in February 2021. I want to give you an idea as to how it is we're looking at the energy transition to net zero. Clearly a very important theme in this day and age, but we believe also offers investors ability to access really interesting infrastructure-like investment opportunities globally, and that goes through to how we see the implementation of the energy transition. So just 3 points I wanted you to note from this slide, fundamentally, as we put together the strategy behind GSEO, as the ticker name is we want to offer investors the ability to access private markets energy transactions globally. We are, as a cohort of managers, we come from a significant track record of investing and financing in energy projects globally. I've been doing it for the last 30 years. I've managed investments and invested in infrastructure across the whole energy value chain, including conventional and renewable technology across different markets throughout the world as well. The returns is a pretty important aspect for investors as well, because we hear a lot, particularly as I attend a lot of speaking engagements where managers get asked, what is the importance, what's the significance of investing in the energy transition, apart from the fact, that we need to invest in it. It's clearly an important to our future, certainly our survival, but what else? And that's really the starting point for us. Apart from the fact that we do need to invest in it for a better future, it offers investors actually a very interesting way to access very differentiated yields in particular energy markets, because we believe, and this is the thesis that we have underlying our investments, the energy transition is so disruptive to the world of infrastructure. It's on par with the Industrial Revolution. It's almost like the second Industrial Revolution. As it gets internalized in different liberalized energy markets throughout the world, it creates some form of dislocation, some form of market dislocation, something in short supply in those energy markets. And by investing in a way to help solve for that thing in short supply, that structural demand gap, as we call it, you can get a differentiated return, and you can also make a positive sustainability impact as well, which goes on to the third point there. Really, we want to ensure we create positive environmental and social impacts through our investments as well. Now, as an overview to the listed trust, it's underpinned by certain themes. One of them is the diverse opportunity set. As we bring together these private market opportunities, we're really creating a strategy where you can get exposure to different energy technologies, proven technologies, whether it's wind or solar or battery storage, geothermal, any number of proven technologies that assist in the energy transition. We are technology agnostic and also geographically diverse as well, because we believe the real way to make an impact in the energy transition is not to focus just on the UK or just on solar and wind in the UK or indeed just in Western Europe. It's a global phenomena. It needs to be addressed within a global format. And we have the ability to seek out and find those real opportunities to get a differentiated return and also make an impact through having this diverse geographic remit. We have sector-leading returns, we believe, target total NAV return, net of leverage and costs of about 10% on an annualized basis for the period of to June 2024. That came in at about 8%. It demonstrates really our ability to seek out interesting investment opportunities, real asset investment opportunities, and I'm going to take you through a little bit of that as we move through the slides. One other fundamental thing you should also note amongst all of this is that the revenue streams that we bring that go into our investments are really infrastructure-like. You have clear line of visibility, long-term visibility under these investments through long-term revenue contracts. And they underpin pretty much over 90% of our investments. And these revenue contracts are also inflation-linked without any caps as well. And that provides investors with significant level of protection, especially as we've seen in the recent past. I wanted to touch just very quickly on this slide because I think this gives you a clear idea as to how it is we progress with our investments. Now, a lot of managers seek to enter into investment considerations through looking at the underlying commerciality of it before seeking some relevance from a sustainability or ESG perspective. This slide actually just states that we look at new investments through the sustainability lens first. It has to meet with our criteria of sustainability. We adopted the UN Sustainable Development Goals. You may have seen some of these colored boxes on previous presentations. There are 6 here that relate principally to investment in energy infrastructure and the positive consequences of that on society, generally speaking. So it has to fit through one of these 6 before we characterize it in terms of one of the 4 phenomena that we see in the energy transition. Of course, the energy transition to net zero deals with climate change. Our investment either has to fit into addressing climate change or providing access to clean and affordable energy, energy efficiency, and other important phenomena. And lastly, market liberalization, because through investing in liberalized energy markets, can you upgrade the infrastructure to enable the energy transition. And it's only once we've gone through all of these boxes, then we look at the investment from a commerciality perspective. And for that, we're looking at 3 key elements here in terms of assessing an underlying investment. The first one, as I've alluded to earlier, the investment needs to meet a structural demand gap in that particular energy market that we're addressing. And I'll give you one very good example of that. In the UK, what is the structural demand gap? Is the gap the fact that there is insufficient capital to enable renewable energy investment and therefore, we're not going to meet our objectives? No, that's not a gap. Clearly, renewables have been incredibly successful within the context of the UK. There's a large amount of institutional capital that want to back large-scale renewable projects. The real issue in the UK is that because renewables are so successful, because wind and solar power technology is so successful, that when the wind doesn't blow and the sun doesn't shine, clearly you get stuck for the supply of power when demand goes up. So that gap itself is what we're looking to solve for within the context of the UK. I'm going to demonstrate that with one of our investments that I'll allude to later on in the presentation itself. Secondly, we are active managers as investors ourselves. We seek to buy assets or construct assets that have further optionality around it, meaning we can tinker around with it through tinkering around with its revenue contracts, renegotiating those contracts, getting better terms on those contracts, or indeed devoting more capital, investing further capital to expand those assets that we own in order to create growth opportunities for investors. So you get yield, but we also want you to have that growth opportunity as well. So the asset that we look at needs to have the ability for us to further optimize or hybridize them. And finally, we need to make a positive environmental and social impact because we are ultimately sustainable investors. Now, we have a unique operating model because we want to address the full spectrum of global sustainable energy from our base in London. And how do we do that? Well, we have significant amount of investment experience within this context that sits in London, but we enter into joint venture agreements with our what we call operating partners. Who are these operating partners? Well, they come from different energy markets throughout the world. We identify them because we believe they have a specific insight into that particular energy market and how to implement the energy transition in that market in the most effective way that gets us as a manager and gets our shareholders a best differentiated return. And they have pretty much expertise in different types of technology. So you have a range of about 5 there that deal with. The first one is in Paraty in Brazil. They operate a hydro facility, a 200 megawatts hydro facility in Brazil. We have distributed solar and battery storage in Australia through Birdwood Energy. In Landmark Power in the UK, a very unique program where we have a flexible power plant using natural gas with also a carbon capture element on there, so we abate fully the CO2 that comes out. In fact, we scrub it into a product called food-grade CO2, purified food-grade CO2, a pretty important industrial gas for the food and beverage market. Motus Energy, the operators of our fuel storage terminals in Texas in the US, and then Energia, the operator of our distributed solar plants in Brazil. So through our joint venture arrangements arrangements with these operating partners. We incentivize them by offering them a profit share in the assets as they have become fully developed and constructed, and so they're aligned with us over the long term. We can address through them the different liberalized energy markets throughout the world, currently running at 4 in the period under review. That's Brazil, Australia, the UK, and the US. But post-period, we actually announced a further acquisition in Spain, in Western Europe. So that's another add-on here that we're addressing. Now, one of the things that you'd like to understand is, yes, in real assets, infrastructure, you would expect some form of yield from it over the long term, but how can you create real growth value in it? And this is a slide I wanted to present to demonstrate to you how it is in the conditions, the market conditions in the equities markets. So certainly over the last 12 months or so, we've been asked many times about the discount to our share price to the NAV that's persistent in the investment trust market as it relates to real assets. We wanted to give investors a real idea of what is the value creation actually that you could have. Well, here we have fuel storage terminals on the border between Texas and Mexico. It's pretty important to have these assets if you want to decarbonize the Mexican fuels value chain, because they shift their dirty fuels that are heavy sulfur content into the US, where they have state-of-the-art refineries that can take out all the heavy sulfur content, make them Euro-compliant fuel products that can then be shipped across the border again to be utilized in Mexico for power generation and for transportation, and therefore make a positive sustainability impact. You need these assets to be able to hold them as they transit across the border. We initially acquired these assets post-IPO in 2021. We renegotiated the contract terms as we acquired it with our biggest client, which is the National Energy Company of Mexico. We increased their throughput usage. We increased the pricing for them because we realized they needed this facility. There were very little alternatives. And ultimately, we dedicated further capital to expanding the asset by a further 300,000 barrels. It's now thereabouts 850,000 barrel facility. And through all of these activities since 2021, we took an asset that was generating a $6 million a year EBITDA, and we converted it into something that is generating a $15 million a year EBITDA, more than double the EBITDA on this, through active management, because we are active managers. Some of the interim highlights as of the period, as of June 2024 on GSEO, the investment trust company. The portfolio net asset value currently thereabouts £447 million, which translates to about 110p per share. Dividend coverage, it's fully covered, 1.1 times dividend covered, with a total annualized NAV return since IPO of about 8%. I think the annualized yield based on current share price is about 7.5%. And just the last point on the right here, as an investment trust focused on infrastructure, we have the lowest leverage of any of our peers in the sector, just about under 2% leverage. That's you can see at the portfolio level. That's based on leverage actually on one of the assets. We don't have any structural leverage at the portfolio level at all. So that demonstrates the significant amount of flexibility that allows us to be resilient as well in the market. You'll note in the second line below that as well, we see we monitor the impact that we make through our investments very seriously. As a listed trust, GSEO is SFDR 9 compliant under TCFD regulations. So there's a significant amount of accounting we do on a regular basis together through our quarterly results announcements that our head of sustainability does, accounting for the tons of carbon dioxide, for example, equivalent that we've avoided during the period of time, the amount of clean energy generated in terms of electrons, and the approximate equivalent of UK homes that get powered by these electrons, etc. So we take that pretty seriously. Now, the portfolio, this is an area of interest that I've alluded to before. By design, we thought the energy transition would be a global phenomenon. The only way to be able to access it and to make an impact is to address it within the global context. But what's the real global phenomenon that we're facing in terms of the way that we use energy? Well, the way that we use energy is transitioning to electrons more than anything else. And electrons, as a share of final energy consumption, is due to go up to 30% in 2030 from 20% currently. And in terms of the amount of capital that's been invested in energy globally as a whole, that's due to hit $3 trillion for the first time by the end of this year. 60% of that investment is going into clean energy infrastructure, which is where we're participating. And because we're not restricting ourselves to either being just a solar-only fund or just a core renewables fund, we can access that opportunity set. That's open to us because we are geographically diverse and technologically agnostic as well. Now, one of the factors that is driving demand for those electrons on the right-hand side, I'm going to echo some of the previous talkers about this. It had traditionally been assumed that these green electrons, these renewable electron sources would help us decarbonize our homes, decarbonize transportation, and decarbonize industry. And those would be the three key areas of usage. But actually, there's a new demand center that is just completely reshaping the landscape, and that's actually AI. The amount of energy that is required to power AI applications is not something that we've seen in any recent times in terms of the demand dynamics. You would see that if you were to apply the same task from Google to ChatGPT, it takes up at least 6 to 10 times more energy to complete the same task. And all of our front-end applications, digital applications, are now being back-ended by AI. And it's assumed, actually, that increased demand in AI by 2026 is going to be roughly about 1,000 terawatt hours, which is equivalent of the total demand of energy for Japan as a country. That demonstrates the significant amount of energy demand that is coming through the system now. Within the context of Europe, that equates to about 220 terawatt hours. So lots of electrons needed in this sector, green electrons in particular, and that's what we're investing in with our strategy across these liberalized energy markets. So the portfolio as a glance, in terms of the global exposure, 36 assets currently and counting across 7 jurisdictions across the world. We're talking about the likes of Spain in Europe, UK, talking about Portugal, Sweden, the US, Brazil, and Australia as well. These are liberalized energy markets that we're targeting our investments to. And you'll see on the right-hand side here a makeup of the technology that we're investing in, anywhere between terminal storage, fuel storage terminals in Texas, to hydro facilities in Brazil, distributed solar and battery storage combined hybrid facilities in Australia, to this really unique flexible power program in the UK with carbon capture on there as well. Highly fragmented, but offers investors some level of hedging as well, some level of risk mitigation, because we have maximum limits on the amounts that we can assume in particular technologies, particular geographies, and particular operating partners that we team up with as well. One other thing I would point out on the top left-hand corner there, portfolio by status, whether it's in construction or whether it's operational. Now, we are enabling the energy transition, so we will always invest in new assets that we build and we bring online. Currently, as of the end of the reporting period, the portfolio, 61% had been operational and been generating cash flow. We believe that number is going to go up to about 80% by the end of this year. And 2025 is really the golden age for the portfolio as it currently stands, where pretty much all of the portfolio will be up and running and generating cash flows under these long-term revenue contracts. It's a highly cash-generative portfolio in itself. However, moving forward, as we raise more capital will also still be dedicated towards the construction part of the portfolio as we acquire new sites to build on, etc. Some of the assets that we've acquired and built out, I'm not going to go through all of them. Just a couple of points to note. They are geographically and technologically diverse. Very, very minimal amount of leverage in the overall system here. Only 7.5% leverage on one particular asset, which was in the US. Other assets are unlevered at the moment, yet still generating pretty interesting differentiated returns in our portfolio. Also geographically, as I mentioned before, and technologically diverse. Now, these assets have infrastructure-like characteristics because they get revenue contracts that you have high visibility of. You see some of the PPA terms, these revenue contracts for power, running up to 20 years, 15 years on average on 2 of those. We have a 3-year rolling contract on the US terminal storage asset with the National Energy Company of Mexico, but that's 3 years renewable. We have the opportunity of renegotiating the price every 3 years, but it automatically renews over that period of time. And one other thing that I would note in relation to these assets is, as we value these assets, using our methodologies, we tend not to assume all the additional optionality or the additional commercial optionality we have to either re-commercialize these contracts, to either put further capital in to hybridize these assets, etc., which we believe is the upside. We offer investors a base case view, but there is significant amount of optionality in these assets in terms of what we want to do with them as we move forward as well. One last point I want to know on ESG. Of course, I've mentioned before, pretty significant in terms of the work that we do. It's in all our published materials, including our latest interim reports. Eleanor Fraser-Smith, our head of sustainability, undertakes a significant amount of work in relation to this. Here are some of the metrics that we measure in terms of UN SDGs, in terms of clean energy generated, etc. I know I'm out of time now. Happy to answer some questions.
Okay, thank you very much. Steve, gentleman here, please. Thank you. Thank you.
Thank you very much. It's interesting to see the extremely low debt in the company, in the group, and it's so unusual to see that. It kind of raises the question: is it partly that it's low because you haven't been able to find enough projects to beat the debt cost, and so you're just investing what was put into the raised as capital in the first place? So that's one question. The other question I have is, there's quite a lot in Brazil, apart from other places around the world. So exchange rate is an issue, must be an issue for you. How do you deal with that aspect of investing?
Yeah, thank you. So I'm going to take the second question first, because that's quite a straightforward question. Look, I mean, the way that we have designed the portfolio is that we don't hedge the underlying assets. Because the cost of hedging something over 25 years, the length of the assets, etc., is prohibitive and creates further volatility in the portfolio. What we've accepted right at the outset is on a blended basis, given that we have differentiated geographies that we invest in. We invest in sterling, we invest in dollars, we invest in the different local currencies. We are getting income in the local currencies as well. We believe in the purchasing price parity theory of everything coming together in the long term, because we are long-term investors. In the short term, what we're doing is we're hedging the dividend flows that we get back from the different geographies that we have. We have an active hedging arrangement in place, and we consistently every quarter review the flows to see what's the best method of either hedging it or leaving it open or partially hedging those flows back. But the underlying value of those investments we retain in the local currencies. The second point to note in terms of the use of leverage is we've chosen actively not to use leverage in this at the outset, although we would do it if it makes sense for us. We have that option to use it, but it doesn't drive the investment. Okay, the types of return that you see at an aggregate level, we're currently 8%, unlevered. On an annualized basis. That type of return we've actually managed to secure through the way that we invest, through investing to fill that structural demand gap in those different energy markets, really. Getting the right type of commercial arrangements in place. We are post-subsidy. We don't depend on subsidy. We don't depend on tariffs. okay, that some other strategies do, where they look to secure, say, a 20-year tariff or a 20-year subsidy for a renewables plant, and in order to make the returns work for them, they have to lever these through the usage of 70-80% debt in the capital allocation. We don't need to do any of that, and we want to offer investors direct access to the yield. If you have debt in place, then you're going to have to service the debt first before you service your own shareholders, and we don't like that. So we're giving you the full cream version of the energy transition, as opposed to something that requires debt and requires subsidy. That's not where we're playing.
Okay, gentleman at the back, please. It's on, go on.
Thank you for very insightful presentation. Two questions. One is about your investment strategy. If I understood you correctly, you are investing directly in the projects and assets through the joint venture with operating partners. So you are effectively a financing partner with a minority stake or maybe a majority stake.
No, we own these. We own these assets outright.
So what would be the role of operating partners? Are they just contractors? They just operate? They have service agreements with you?
Yeah.
Okay.
So the model that we have, just to go back there, perhaps. So the model that we have with our operating partner, these are the 5 that we're showing here, is we want alignment with them because we believe we're offering them growth capital, but not by capitalizing them. We're offering them growth capital by actually capitalizing the pipeline of development projects they have. So they come to us with programs, with not one project that we need to fund, but they have 6, maybe 10 projects, a whole pipeline. That's what they're offering us. And in return, we use our capital to construct those projects, to own them, to construct them, but we offer our operating partners a profit share in those arrangements. We're taking elements of private equity in terms of having an operating partner where they have to earn a minimum hurdle and then they can have a catch-up, etc. This profit share element is what they get in the assets and therefore aligns them with us in the long term of the assets as well. So that's under our participation agreement with our operating partners, and we also have a very standard operating services agreement as well, where we can, we have bonus malus clauses. If they do something well, they get rewarded for it. If they don't, then we have the ability to claw back payments, etc., to keep them honest as well. So they are almost like a co-venturer, but it's our capital and we own them.
Thank you. And second question about, you mentioned 3 kind of strategies, and one of them, 3 elements of the strategy. One is dysfunctionality in or disconnect in capital. The best way for decarbonization and energy transition is probably investing in carbon storage and utilization projects. Do you plan or do you have these kind of projects in your pipeline? Thank you.
Yeah, no, that's a good point. And just to point out one of the projects here. Here we go here, the UK flexible power plant with carbon capture and reuse. So look, I mean, within the context of the UK where, there's a significant amount of leadership that's been provided in carbon capture and storage at the moment, it's economically still unsure, okay? It requires significant amounts of subsidy. We've decided to approach the problem a different way. Instead of looking at large-scale natural gas-fired power plants, 100, 200 megawatts, etc., we're looking at distributed, smaller-scale natural gas-fired power plants. We don't require subsidy. This has no subsidy, only commercial arrangements with a utility that buys the power, and then we take the CO2 that gets generated as you burn the natural gas. That all gets abated. We have a carbon capture and reuse technology. We scrub that CO2 into a purified food-grade CO2, which is a really highly precious industrial gas in the UK because it gets used in the manufacture, for example, of beer. And a lot of the supply of this particular industrial gas came from the production of ammonia plants. They've all been closed down. They've become uneconomic, so we get stuck for that. So we have another sustainability impact we make with our investment by actually fulfilling that through a net zero way, producing that purified food-grade CO2 in a very sustainable way as well. So we're making 2 sustainability impacts, 0 subsidy base.
Gentleman here with the microphone.
My question was related to what one of my participants raised already, but I want to ask, it sounds as if you're helping primarily with finance, that the technical experts are the 5 partners you're working with. what gives you a USP compared to your competitors? So who are your competitors, and what makes you stand out in the bunch?
No, it's good question. So there's a couple of things to unpack there, because the first thing to unpack fundamentally is, yes, ultimately we are financiers, but we have an edge in that in terms of we understand how energy markets operate, okay? The whole rationale behind this strategy is not the technology. We're not just focused on solar. Solar is not going to save the world by itself. What we're focused on is the underlying energy market that it operates in, the liberalized energy market. And we have a very good understanding of that. Okay. And we have a lot of developers that come to us and say, hey, I can develop for you a renewable project at the cheapest marginal cost in the UK, for example. And we say to them, what is the type of returns you would get for something like that? And they're telling us, it's a compressed single-digit return. Why is that an interesting investment opportunity for us? It clearly isn't. We want there to be a differentiated return for our shareholders. And we know the types of markets where we can achieve that and the manner in which we can achieve that and the type of technology we can use to achieve that. That's what we're good at as a manager. Now, we combine ourselves with an operating partner that has the specific knowledge of a particular technology and where it fits into that particular energy market. So the combination of the two delivers the result fundamentally. Okay, that's the way we tend to work.
Thank you. This gentleman here with the microphone.
Sorry, a question about you said 100% of your assets are going to be cash generative in 2025. So what's the implications for returns of that? First part. Second part, obviously some of those are then mature because you've done the active management and added value. So how does the portfolio you've put up, how does it change? Where are the exits that allow you then to reinvest in newer, younger assets?
Yeah, so there's a couple of questions there. I guess the first one is, where does the growth come from fundamentally in this portfolio? And the growth doesn't only end when we construct the assets, and that's a key point in terms of how we interact with our investments. We look for investments where we can construct them in the first instance. They can generate revenues, but they also have the ability for us to better commercialize them in the short to medium term, or indeed put something else on them as well. A very good example of that are the Australian solar assets, where clearly irradiation levels in Australia very high, and there's also a significant amount of volatility in terms of the power price, because in the daytime with a significant amount of solar, prices are very low, but in the mornings and the evenings where there's peak demands, there's actually insufficient solar resource, so the price spikes. So one way of getting better returns out of this is to connect it with battery storage on site. You can actually store the cheap or zero cost solar on your site and generate it when the prices have peaked. So that gives you an idea of the way that we look at it. We built the solar sites, we acquired a couple of operating solar sites, and then we put battery storage on them in the first instance. Then we're going to go into accessing further revenue opportunities on the grid with that battery storage and solar sites moving forward as well. So that's another iteration of our value creation as well. So we're consistently looking at how we can create further value over time. As it relates to the growth from construction to operations, how we value the asset, there is generally a NAV pop as we transition assets from the construction phase into the operating phase, because we value them at cost during construction, then DCF modeling during operations. So there is a gradual shift upwards that as these assets come online during next year, there will be a natural growth in terms of the NAV as well. Now, in terms of capital allocation, your other point, where do we go from here? There are various ways, and we're consistently thinking about various ways of allocating capital. And of course, some of these projects, some of these programs, we were the first mover, such as in Brazil, distributed solar, in Australia as well. We're starting to get positive price signals coming through in the local markets. It isn't our intention to divest at any given time, but if the offer is interesting enough, we would do that. And what does interesting enough mean for us? It means being able to prove a NAV well north of where, the fund's NAV is, basically, to show that value creation in our assets itself. And the good thing for us is there's hardly any leverage for us to actually service with that capital that gets returned. Repaying debt is not part of our story. What we'd be looking to do with that return capital is deciding whether or not we double down in that particular market and look to reinvest in another opportunity, or actually do a combination of offering investors cash back and doing that as well. So that's some of the things that we think about on an active basis. And of course, there is always leverage that we can apply on operating assets as well. We've got a pretty significant amount of capacity to put that on the portfolio.
Yeah, but essentially we should expect a very low turnover portfolio where you've got room to add more value over the next 5 to 10 years.
Yeah, no, absolutely.
Is that right?
Yeah, no, absolutely. Yeah, so these revenue contracts go on 15, some of them, the latest one 15 years.
Yeah.
And during that period of time, we're not expecting to switch these on and go on holiday 15 years. We want to see what else we can do with these assets. And that's where, we're not technologists, we're not engineers, but we know how to commercialize things, and that's our interest.